Hi everyone, I'm Wanchang from UC San Diego. It's a great honor to be here. Today I'm going to tell you something about random double auction, a robust bilateral trading mechanism. At every moment, a huge amount of trades are facilitated by intermediaries who charge fees for their intermediary services in matching buyers and resellers. For example, stocks transacted through a trading platform that typically gets compensations by means of commissions. Cars are transacted through an automobile dealer who charge dealer fees. For another example, many bonds, commodities, and derivatives are transacted in the over-the-counter market, where a market maker earns profit through that beta spread. In this work, I studied the design of a trading platform for a profit-maximizing intermediary, which is a fundamental question in economics. In reality, there are many situations in which the uncertainty about the value of the asset being traded is huge. For example, newly public stock or Tesla new model. The intermediary may then have little information of the concerned parties' willingness to trade and only have an overall estimate about it. Given huge uncertainty towards the two-sided market, it is natural for the intermediary to seek for a trading mechanism that guarantees a good profit, regardless of the informational environment that the intermediary is faced with. So I'm going to ask and answer the questions: how should profit-maximizing intermediary design trading rules in such situations? Will the intermediary still be able to guarantee a positive profit and thus have a straight incentive to offer intermediary services? In a nutshell, I'm going to design a trade mechanism that maximizes the worst-case performance. Such a mechanism is referred to as a maximum trading mechanism. I will be specific about what is worst case when I present the formal model. In this talk, I'm going to first present a model of a robust mechanism design problem. And given the time constraint, I'm going to focus on the characterization of maximum trading mechanisms for symmetric informational environment, which I will elaborate after I present the formal result. Let me jump into the model environment. Two traders, the seller and the buyer, are trading assets through an intermediary. The seller initially holds the asset. This is standard correlated private value environment. That is, trader I knows his own private value, VI. VB and VS may be correlated. Some notations. Capital VI denotes the set of all possible values of trader I. As a normalization, VI is taken to be the unit interval. Importantly, 1 is a normalized maximum value of each trader. Capital V is a set of all possible value profiles with a typical value profile lowercase v. The Zhang distribution is denoted by pi. There's no restriction on the correlation structures. That is, pi can be any arbitrary correlated distribution. And importantly, there's no technical assumptions on pi. That is, pi can be a discrete distribution, a continuous distribution, or any mixture. And the delta V is a set of all possible joint distributions over capital V. The important assumption that they make is that the intermediary has limited information about the value distributions of the traders. Specifically, I'm going to assume the intermediary only knows the expectations MB and MS of the price value of the buyer and the seller, respectively, as well as the set of all possible value profiles, but does not know the joint distribution pi of the values of the traders. That is, the intermediaries knows neither the marginal distributions nor the correlation structure, except for the two parameters, the expectations and BMS. And I refer to any joint distribution consistent with the non-expectations as a feasible value distribution. And pi, MS, and MB is a set of all feasible value distributions that the intermediary regards as possible. Mechanisms. I'm going to restrict attention to the class of all dominant strategy incentive compatible DSIC and its post individually rational EPR mechanisms. This class of mechanism is both of significant theoretical interest and practical. It per se embodies robust properties as dominant strategy trading mechanisms does not rely on any assumptions of traders' beliefs. Given this restriction, the relation principle holds, and is without loss to attention to direct mechanisms, which is a triple consisting of a trading rule Q and two transfer rules TBTS. The trading rule Q maps the reported value profile into a trading probability. And transfer rule, for example, TB, specifies how much the buyer should pay, and likewise, TS specifies how much the seller should receive given the reported value profile. And the set of all DSIC and APR mechanisms is denoted as D, and the constraints are standard. The objective. The intermediary's post-profit from a value profile is the difference between what the buyer pays and what the seller receives. The intermediary is gonna evaluate the mechanism by its worst case expected profit over all feasible value distributions. And this worst case expected profit is referred to as the profit guarantee. So look at the integral here. This integral is an expected profit given a trading mechanism QTBTS and given a feasible value distribution pi. So given a trading mechanism QTBTS, one can imagine that there exists an adversarial nature who chooses a feasible value distribution to minimize the expected profit to the intermediary. The intermediary's problem is to find a mechanism that maximizes the worst case expected profit across all DSIC and EPR mechanisms. And such a mechanism is a maximum trading mechanism. I'm going to take the set point approach to solve for this maximum problem. That is, I'm going to construct a pair consisting of a trading mechanism Q star, TB star, TS star, and the feasible value distribution pi star, such that against pi star, Q star, TB star, TS star maximizes the expected profit across all DSIC and EPR mechanisms. And given Q star, TB star, TS star, pi star minimizes the expected profit across all feasible value distributions. The properties of saddle point imply that if we succeed in constructing such a pair, then Q star, TB star, TS star, the mechanism that I construct, exactly what I want. That is, it is a maximum trading mechanism. I'm going to focus on the case in which environment in which the expectations of the buyer is greater than the expectation of the seller. I call such environments non-trivial informational environments. This is because otherwise the adversarial nature can choose a degenerate distribution, which is the point mass on MBMS, and expose individual rationality constraint imply that no mechanism can achieve a positive expected profit, rendering the analysis uninteresting. Sorry. Now this is the essential slide. This is the mechanism that I construct, which I call random double auction. I will first describe this mechanism, and then I will state the formal result. And afterwards, I will illustrate ideas behind. Random double auction is described via 3 steps. Step 0 is fixed commission fee. The intermediary publicly commits to charging a fixed commission fee, where this fixed commission fee is specified by the non-expectation MBNS in the following way. Step 1 is the uniformly random spread. The intermediary publicly commits to randomly drawing a spread uniformly from the closing interval R1. Then a random spread is drawn from this uniform distribution, whose realization is not observed by either the buyer or the seller. So what do buyer and seller know? The buyer and the seller both know the fixed commission fee and know the uniform distribution from which a random spread will be drawn. Step 2 is midpoint transaction price. The buyer submits a bid price and the seller submits ask price simultaneously. If the difference between the bid and ask is greater than the realized spread, then the seller sells the asset to the buyer at the midpoint price, and each pays the intermediary half of the fixed commission fee. Otherwise, no trade takes place and no one pays or receives anything. So conditional on trading, this mechanism is indeed a double auction. The main novelty is fixed commission fee and the uniform random spread. Let me use one numerical example to illustrate how random double auction works. So suppose you're a buyer, and suppose there's a buyer, and the buyer bids 50 cents, and seller asks 30 cents. The canonical double auction says the transaction should take place, and the transaction price is the midpoint, which is 40 cents. But my mechanism, random double auction, says, no, the transaction does not always take place. It only takes place randomly. Whether the trade takes place or not depends on a randomly drawn spread. And in this case, if the spread is greater than the difference between 50 and 30, which is 20 cents, then no transaction takes place and no one pays or receives anything. The trade takes place if and only if the random spread is below the difference between 50 and 30, which is 20 cents. And when it takes place, then the transaction price is the midpoint, 40 cents, plus each will pay the intermediary half of the fixed commission fee. Now let me state the formal result. The formal result says for the symmetric informational environment in which the sum of the expectations is a normalized maximum value 1. Random double auction is a maximum trading mechanism, and the profit guarantee is this amount and it is positive. So a little bit about why this is symmetric informational environment. So in this environment, the one value seller is indeed the lowest type of seller in the standard mechanism design language. This is because one value seller has the lowest willingness to trade. And when this condition holds, then the distances between the expectation and the lowest type, which is 0 for the buyer and 1 for the seller, are the same for both the buyer and the seller. In this sense, I call this case, these environments, symmetric informational environments. So let me illustrate the idea behind the random double auction. First, it is strategy proof. This is extremely surprising, perhaps, because, as I just mentioned, conditional on trading, this mechanism is a double auction. And we know that double auction per se is not strategy proof. Why? Because if you look at the buyer, actually the buyer has the incentive to submit a bid lower than his true value. By doing so, he can lower the transaction price and make this deviation profitable. The idea is to make it costly for the trader to cheat. So how do I do that? A random double auction can do this. A random spread will do this. A random spread will decrease such incentive. Why? Because now with the random spread, if the buyer submits a lower bid, then trade will take place with also low probability, which limits the profit from deviation. The miracle is that a carefully chosen random spread, uniformly random spread, eliminates such incentives and makes the mechanism strategy proof. Just bear with me a little bit. I will show one line of algebra to illustrate it. So let's work out the buyer's exposed payoff from submitting a bid price B when his true value is VB, and the seller submits an arbitrary ask price A. The first term here is a trading probability. And this is a linear function because of the uniformly random spread. The second term is the exposed payoff to the buyer, conditional on trading, which is the difference between his true value, VB, and the sum of the transaction price and the half of the fixed commission fee paid by the buyer. This exposed payoff function is indeed a quadratic function with respect to the bid price B. It's straightforward to show that B being equal to VB is the unique maximizer of this function, regardless of A or even R. So this shows random double auction is strategy proof. Second, random double auction always has a positive profit. By always, I mean for any non-trivial informational environment. This may also be viewed as a miracle relatively to the deterministic maximum trading mechanism, which I also characterize in the paper, and I find that the profit guarantee is 0 for the deterministic mechanisms for a range of non-trivial informational environment. Now let me illustrate how I derive the profit guarantee for random double auction with a general fixed commission fee. The first step is to work out the exposed profit from value profile. And to see this, let's work out the profit collected from the bid as pair when the difference is greater than the fixed commission fee. So look at this term. So again, the first term is trading probability. And recall that uniform random spread translates into a linear trading probability. And the second term is the exposed profit earned by the intermediary conditional trading. This is exactly the fixed commission fee. So a linear trading probability product, a fixed commission fee, is again a linear function, which plays a crucial role in deriving the profit guarantee of random double auction. And when the difference is below the fixed commission fee, then no trade takes place, and trivially the profit is zero. The second step is to work out the lower bound or expected profit. To see this, look at the first term. The first term is the expected profit, and the equality holds simply because of adjacency equality. And the equality holds because the first term, this term, the exposed profit is a linear function when it's positive. And the third step is to show that this lower bound can be hit. And this is straightforward to show because the general distribution which point mass on MBMS yields the profit, hit this expected profit. And we can see that any fixed commission fee below the difference between the expectations has a positive profit guarantee. And the pre-claimed fixed commission fee maximizes this profit guarantee across all fixed commission fees. And from the analysis so far, we can also see random double auction exhibit a good hedging property. The intermediary under random double auction would be indifferent to any feasible value distributions whose support is contained in the set of value profiles where the difference between values is greater than fixed commission fee. This renders random double auction a good candidate for max-min trading mechanism. And to show it's a max-min trading mechanism, I constructed the most adversarial called value distribution, which I call symmetric triangular value distribution. The salient feature is that the support is a symmetric triangular subset of joint values, and there's atom on 1, 0. In terms of marginal distributions, is a combination of uniform distribution and atom, and for the conditional distribution, is a generalized Pareto distribution with the atom. I show that against this symmetric triangular value distribution, random double auction is optimal. So far, I constructed such a pair of saddle point. So let me quickly jump into the conclusion. So the main takeaway is that I construct the novel random double auction as a robust bilateral trading mechanism. And indeed, the random double auction is both familiar and novel. It's this combination of three commonly observed features: random spread plus fixed commission fee plus double auction. Random spread, well, there is extensive evidence that spread is not constant, it's changing over time. And for fixed commission fee, well, many brokerage firms and trading platforms adopt fixed commission practice. Double auction, well, many stock exchanges, for example, New York Stock Exchange, use a double auction to determine the opening prices. And thank you so much for your attention.
You have time for questions?
Yeah, could you briefly talk about the intricacies that would happen if you would try to translate your mechanism to more than one buyer and more than one seller? Because I would assume that this could be quite technical, no? And I mean, what you do is basically, with this random spread, you force strategy proofness by reducing the efficiency of sometime not having trade happen. And I would assume that this would just get worse and worse if the market gets larger.
So I was working in the extension to multiple buyers and multiple traders. And actually for the larger numbers, I can still use similar techniques to extend random double auction. so that we still have basically n times of the profit guarantee from one pair of the traders. And for the general, the max mean problem, I'm still working on it. Thank you.
I don't see any questions online. Thomas, no questions online, are there? Okay, thanks again. And let's thank all 4 speakers in the session again. And I believe you can now pick up lunch and go to the town hall, is that right?